Hello everyone, my name is Pieter Stalens and I would like to introduce you to CVC Credit Partners European Opportunities Limited. This is a company that actively manages a portfolio of sub-investment grade debt, predominantly investing in European loans and bonds, with a target net return of around 8% per annum. Let me start by introducing you to CVC. CVC is a market leader in global credit and private equity. As you can see from the chart below, we manage around $109 billion in assets. As a group, we manage funds for over 750 institutional investors from across the world who trust CVC to grow and protect their capital. Most of you probably know us from the private equity side of the business, which is where around 75% of our assets under management are held. CVC Private Equity was established in 1981 and buys and operates large businesses. Some examples you may have heard of include Formula One, the RAC, Sky Bet, Virgin Active, or even Premiership Rugby. The credit part of the business has around $27 billion assets under management and comprises a team of 49 investment professionals across London and New York. CVC Credit's senior leadership team is staffed by highly experienced professionals that have been working in the industry for an average of over 25 years. You can also see from this chart that we have 23 offices worldwide across the firm. This gives us a big advantage as we have access to local people on the ground. So we have a much better view on what's happening locally, be it from a competitive point of view, regulatory point of view, etc. So what is CVC European Credit Opportunities? We invest in fixed income instruments, mainly European loans, on which we receive an income. We then distribute this income in the form of a dividend and currently pay a 4.5% annual dividend. Our total target return is 8% net of fees, so there is some capital upsides on top of the dividend distribution. The strategy was implemented in 2009 and we have achieved 8.8% net of fees since inception up to the end of December 2020. The company is listed on the London Stock Exchange and hence you can get daily liquidity in the shares. There is also a mechanism where you can sell us your shares back at the net asset value on a quarterly basis, once you've been a holder for over 6 months. Our geographic focus is Europe. We have some investments in the US as well, but we don't really invest in emerging markets as we like the stability and predictability of the legal framework in Europe and North America. The key benefits for investors is the attractive current yield on the stock, which is eligible for ISAs and SIPs. The structurally senior position in the capital structure and the financial incurrence covenants provide downside protection for investors. And I will get back to this point later in the presentation. There is also strong alignment for investors with the manager, as a lot of partner capital is invested in the strategy. The next slide visualizes a bit more what kind of businesses we invest in. You can see a snapshot of businesses we are currently invested in or have historically been invested in. Most of you probably recognize a lot of these names. What we like about these investments generally is that they typically have market-leading positions and a certain level of predictability around cash flows, which is important as this is what ultimately pays our interest. You can also see that the average business we invest in has revenues of 3 billion euros in Europe and $4.7 billion in the US. We typically invest in large businesses, which has several advantages from our point of view. Firstly, these loans or bonds for large businesses are typically more liquid in the secondary market, which allows us to risk manage our positions better. Secondly, these businesses tend to have access to different pools of capital, including the loan and the bond market, as well as different currencies, such as sterling, euro, and US dollar. Finally, we also believe these businesses can attract better management teams. On the next slide, you can find the portfolio snapshot as of the 31st of December. I would like to highlight that we are invested in just over 100 different loans or bonds. This means that the average position size is around 1% of the funds. You can also see from the chart on the bottom of this slide that the portfolio is well diversified across a number of geographies and industries. At the end of December, the cash yield on the portfolio was 6.6% and the yield to maturity was around 7%. On slide 6, you can see how the strategy has performed since inception in 2009. We have plotted the performance of the NAV of the fund versus the FTSE 100, adjusted for dividends to make it a true like-for-like comparison. There are a couple of takeaways from this slide. First of all, you can see that over a 12-year period, we have outperformed the FTSE 100 with a net annualized return of 8.8% versus the FTSE 100 8.4%. Secondly, you can also see that in general, the fund experiences less volatility when there is some weakness in the market. We have highlighted the 2011 Eurozone crisis, where the FTSE dropped 7.2% from peak to trough, while the fund only dropped 3.3%. The 2015 oil crisis, where the FTSE dropped 10.5% from peak to trough, while the fund delivered a positive 0.2%. We can also point to Q4 18, where the FTSE 100 dropped 10.4% on the back of trade tensions versus a 2% drop in the fund. In the first quarter of 2020, the fund gave up 20.6% in net performance, while the FTSE was down 24.9% over the same period. However, for the full year 2020, the fund was up 2.4% net, while the FTSE 100 was down 11.5% for the year. Since inception of the strategy, the fund has never had a year of negative returns. And importantly, we have never stopped paying distributions, regardless of the underlying market conditions. Finally, you can see that we have a euro and a sterling share class, with a combined market cap of 320 million euros as at the end of December. The two share classes are identical, except that one is fully hedged in euro and the other one in sterling. They both pay the same quarterly dividends and have the same redemption mechanisms. For further information on the product's risks and other key disclosures, please reference the disclaimers at the end of this presentation. Many thanks.